Hi guys, this is Direk Khanijou and welcome to my podcast. I plan to put out an episode every weekend, so if you're enjoying this format, please subscribe. Today's episode is an introduction to banking. Banking is a business that operates at the center of economic activity. Banks play an important role by taking in deposits and lending money out. This process is called maturity transformation. Now, when analyzing banks, you want to focus on the balance sheet and income statement. I know some investors like to talk in terms of book value when analyzing banks, but I prefer to focus on deposits because that's where the value creation happens. The loans that a bank makes is listed as an asset on the balance sheet, but the deposits that a bank holds is listed as a liability on the balance sheet. Now, even though deposits are listed as a liability, they function more like an asset. Having deposits is what allows a bank to fund its assets, which are loans and debt securities. And there are a few types of deposits. A bank will have a mix of interest-bearing and non-interest-bearing deposits. Let me give you an example. Checking accounts pay little to no interest, but that money can be withdrawn anytime. On the other hand, certificates of deposits, or CDs, pay higher interest rates, but you must leave those funds untouched for a fixed period. Ideally, you want a bank with a deposit base that is high quality, stable, and low cost. Now, I have seen certain banks, and they're typically newer banks or neobanks, that promise higher interest on deposits. To me, that is a sign of franchise weakness, not strength. Now, let's talk about loans. This is usually where the problems happen. To put it simply, banks sometimes go crazy and make stupid loans. This is the big risk when investing in a bank. Now, there are all types of loans. For example, residential mortgages, auto loans, credit card loans, home equity loans, construction loans, small business loans, and much more. Even though the nuances of each loan category are beyond the scope of today's episode, I still want you to remember this. Watch out when a bank starts growing its loan book quickly in a new geography or in a new loan category, especially when it has not shown expertise or success in these areas. In other words, you want a boring bank that sticks to its knitting. And the same principle applies to insurers. Finally, I want to talk about the inherent leverage within banks. Banks today have assets to equity of about 8 to 12 times. This leverage is what allows banks to earn decent return on equity. For example, a bank that earns 1% on its assets and has 10 times assets to equity will have a return on equity of 10%. However, regulators can change the attractiveness of banking by changing capital requirements. To take an extreme example, if every bank had to be 100% equity financed, it would be a terrible business. And because banks are levered institutions, this means any lending mistakes on the asset side can destroy a major portion of equity. In other words, any mistakes by management will be magnified. Let me know if you want to hear me talk more about how I evaluate management at a bank. That's all for today. Subscribe if you enjoyed. Thank you so much for listening.